Hey everyone, and welcome back to the channel. Today we're diving into a high-flying investment vehicle, the ProShares Ultra Pro Midcap 400 ETF, also known as UMDD. That's right, UMDD has been on a tear lately, racking up an impressive 11.66% return. But before you jump in head first, there's a crucial detail to consider: leverage. UMDD uses leverage to amplify its daily returns, which sounds great for gains, but also means magnified losses. So, is UMDD a shortcut to riches or a recipe for disaster? We'll break down the risks and rewards, unpack how UMDD works, and see if it fits your investment style. Stay tuned. What is UMDD ETF? UMDD, ticker symbol for the ProShares Ultra Pro Midcap 400 ETF, is an exchange-traded fund, ETF, designed to deliver magnified, leveraged returns on the performance of the SP Midcap 400 Index. Here's a breakdown of its key aspects. Investment objective. 3x leveraged, UMDD seeks to provide daily returns that are 3x, the daily performance of the SP Midcap 400 Index, before fees and expenses. This means that if the index gains 1% in a day, UMDD aims to deliver a return of approximately 3% on that day. Conversely, if the index loses 1%, UMDD would experience a loss of around 3%. Underlying index. SP Midcap 400 Index. This is a market capitalization-weighted index that tracks the performance of 400 medium-sized, publicly traded companies in the United States. It serves as the benchmark for UMDD, and the ETF uses financial instruments to aim for 3x the daily return of this index. Investment strategy. Leveraged exposure. UMDD achieves its magnified returns by employing leverage. This means the fund uses various financial instruments like derivatives, swaps, or borrowing to amplify the daily movements of the underlying index. Key characteristics. Volatility. Due to leverage, UMDD experiences magnified volatility compared to the SP Midcap 400 Index. This means its price can fluctuate significantly, with larger gains during upswings, but also amplified losses during downturns. Risk and reward. Leverage offers the potential for magnified returns, but it also comes with magnified risk. Investors should be comfortable with higher volatility to consider UMDD. Non-diversified. UMDD holds a basket of securities based on the SP Midcap 400 Index, but it doesn't offer the same level of diversification as a broad market ETF. Fees. UMDD has an expense ratio associated with its management and operation. This fee eats into the returns generated by the ETF. Who should consider UMDD? UMDD is a suitable investment option for experienced investors, investors who understand the risks associated with leverage and volatility. Short-term investors, those seeking potential for magnified gains over a shorter timeframe, as leverage can be more impactful in the short term. Directional market view. Investors with a strong conviction that the midcap sector will outperform the broader market. How much has the 3x leverage played a role in amplifying the gains of UMDD? The 3x leverage employed by UMDD, ProShares Ultra Pro Midcap 400 ETF, has played a significant role in amplifying its recent gains of 11.66%. Here's a breakdown of the leverage impact. Understanding leverage. Magnification effect. Leverage amplifies the daily returns of the underlying index that UMDD tracks. A small gain in the index translates to a larger gain for UMDD, and vice versa. In UMDD's case, the leverage factor is 3, meaning it aims to deliver 3 times the daily return of the SP Midcap 400 Index. Quantifying the amplification. Hypothetical example. Let's say the SP Midcap 400 Index gained 4% during a specific period. Here's how leverage amplifies UMDD's return. Index gain, 4%. UMDD gain, with 3x leverage, 4% x 3 equals 12%. In this scenario, the 4% gain in the underlying index translates to a 12% gain for UMDD due to the 3x leverage factor. Real-world example. UMDD's 11.66% gain. Since UMDD achieved an 11.66% gain, we can estimate the contribution of leverage by assuming a reasonable return for the SP Midcap 400 index during the same period. Estimated index return, UMDD gain, / leverage factor equals 11.66% / 3 is almost equal to 3.89%. Based on this estimation, the SP Midcap 400 index might have gained around 3.89%, and the 3x leverage magnified that gain to 11.66% for UMDD. Key points to remember. Double-edged sword, leverage works both ways. While it amplifies gains during positive market movements, it also magnifies losses during downturns. Focus on underlying performance. Understanding the performance of the SP Midcap 400 index provides context for how much leverage contributed to UMDD's gains. Does UMDD have a history of high portfolio turnover, or is it a more passively managed ETF? UMDD, ProShares Ultra Pro Midcap 400 ETF, falls somewhere between a passively and actively managed ETF due to its leveraged nature. Here's a breakdown to understand its portfolio turnover. Passive versus active management. Passive ETFs, these typically track a specific index and aim to replicate its performance with minimal portfolio turnover. They hold the underlying assets of the index in proportion to their weightings. Active ETFs, these are managed by portfolio managers who actively buy and sell securities based on their investment strategy, leading to higher portfolio turnover. UMDD structure. Leverage tracking. UMDD tracks the SP Midcap 400 index with 3x leverage, aiming to deliver 3 times the daily return of the index. Derivative instruments. To achieve leverage, UMDD utilizes financial instruments like swaps. These instruments might involve frequent adjustments to maintain the desired exposure, leading to some level of portfolio turnover. Does UMDD focus on the smaller or larger end of the midcap spectrum? UMDD, ProShares Ultra Pro Midcap 400 ETF, doesn't specifically target a particular size range within the midcap space. Here's why. Underlying index. SP Midcap 400 Index. UMDD tracks the SP Midcap 400 Index with 3x leverage. This index itself is market capitalization weighted, meaning the holdings within the index are weighted based on their total market value. Market capitalization and midcap. Midcap definition. The definition of midcap can vary slightly depending on the source, but it generally refers to companies with a market capitalization between $2 billion and $10 billion, or sometimes $2 billion and $20 billion. Market cap distribution within SP Midcap 400. Weighted exposure. Since the SP Midcap 400 index is market capitalization weighted, the holdings with the largest market value within the midcap range will have a greater weighting in the index and consequently in UMDD. What this means for UMDD. Exposure across midcap range. By tracking the SP Midcap 400 index, UMDD gains exposure to companies across the entire midcap spectrum, from those closer to the large cap side to those nearing the small cap range, based on their market capitalization at the time. Leveraged impact. The 3x leverage of UMDD amplifies the returns, or losses, of the entire SP Midcap 400 index, regardless of the individual company sizes within it. Alternative midcap options. Size-focused ETFs. If you're interested in targeting a specific size range within the midcap space, There might be other ETFs that focus on smaller or larger mid-cap companies. These ETFs might employ different weighting methodologies to achieve their objectives. What are the advantages and disadvantages of investing in UMDD compared to individual stock picking? Here's a breakdown of the advantages and disadvantages of investing in UMDD, ProShares Ultra Pro Midcap 400 ETF, compared to individual stock picking in the midcap space. UMDD, Leveraged ETF. Advantages. Diversification. UMDD provides exposure to a basket of midcap companies within the SP Midcap 400 Index, reducing single stock risk. Lower costs. Expense ratios of UMDD are typically lower compared to the combined costs of researching and trading individual stocks. Leveraged returns. Potential. UMDD aims to deliver 3x the daily return of the SP Midcap 400 Index, offering the potential for magnified gains, but also magnified losses. Convenience management. UMDD requires minimal ongoing management compared to actively researching and managing a portfolio of individual stocks. Disadvantages. Limited control. You don't have control over the specific companies held within UMDD and cannot tailor the investment to your preferences. Market dependence. UMDD's performance is directly tied to the SP Midcap 400 Index. It won't outperform if the index performs poorly. Leverage risk. The 3x leverage magnifies both gains and losses, amplifying potential volatility and downside risk. Limited transparency. Unlike actively managed funds, UMDD doesn't necessarily disclose daily holdings, making it difficult to assess the underlying company's individual risks. Individual stock picking. Advantages. Greater control. You have complete control over which mid-cap companies you invest in, allowing you to tailor your portfolio to your investment thesis. Potential for higher returns. By selecting high-growth potential stocks, you might achieve returns exceeding those of UMDD, but also risk larger losses. Direct company exposure. You gain direct exposure to the specific companies you believe in and can benefit from their individual growth stories. Disadvantages. Higher research costs. Thoroughly researching and analyzing individual mid-cap companies can be time-consuming and require significant effort. Diversification challenge. Building a diversified portfolio with a limited number of mid-cap stocks can be difficult, increasing single stock risk. Emotional investing risk. Emotional attachment to certain companies can lead to biased investment decisions and poor portfolio management. Trading costs. Transaction costs associated with buying and selling individual stocks can eat into your returns over time. Choosing between UMDD and individual stock picking. Investment goals. Consider your risk tolerance and investment goals. UMDD offers a diversified approach with magnified returns and magnified losses, but limited control. Stock picking allows for customization but requires more effort and carries higher risks. Investment knowledge. Individual stock picking requires a strong understanding of fundamental and technical analysis. UMDD is a simpler option for those less comfortable with active management. Time commitment. Researching and managing a portfolio of individual stocks requires significant time commitment. UMDD offers a more passive approach. What are the potential risks to consider before investing in UMDD? Before investing in UMDD, ProShares Ultra Pro Midcap 400 ETF, it's crucial to understand the potential risks involved. Here's a breakdown of some key considerations. Leverage risk. Amplified volatility. UMDD utilizes 3x leverage, aiming to deliver 3 times the daily return of the SP Midcap 400 Index. This magnifies both gains and losses. Even a small decline in the index can translate into a significant loss for UMDD. Potential for sharper downturns. during market downturns, UMDD's losses can be much sharper compared to the underlying index or a non-leveraged ETF tracking the same index. Market risk. Mid-cap sensitivity. Mid-cap stocks are generally more volatile than large-cap stocks. UMDD's performance is directly tied to the SP Mid-cap 400 index, so it inherits this inherent volatility. Sector concentration risk. The SP Mid-cap 400 index might have a concentration in certain sectors. If those sectors underperform, UMDD's performance will be negatively impacted. Investment strategy risks. Limited control. You don't have control over the specific companies held within UMDD and cannot tailor the investment to your preferences. UMDD tracks the SP Midcap 400 index composition, and its performance depends on the index's overall performance. Passive management. UMDD tracks an index passively, and its performance won't outperform the SP Midcap 400 index even during strong market rallies. Actively managed funds might potentially achieve superior returns through skilled stock selection. Limited transparency. Unlike actively managed funds, UMDD doesn't necessarily disclose daily holdings, making it difficult to assess the underlying company's individual risks and creditworthiness. Is UMDD suitable for all investor risk tolerances? No, UMDD, ProShares Ultra Pro Midcap 400 ETF, is not suitable for all investor risk tolerances. Here's why. UMDD's risk profile. Leveraged volatility. UMDD utilizes 3x leverage, amplifying the daily returns, both gains and losses, of the SP Midcap 400 index. This translates to higher volatility and the potential for significant losses during market downturns. Investor risk tolerance. Risk-averse investors. Investors with a low risk tolerance prioritize capital preservation and are uncomfortable with significant fluctuations in their portfolio value. UMDD's magnified volatility can be detrimental to their investment goals. Moderate risk tolerance. Investors with a moderate risk tolerance can withstand some volatility, but prioritize a balance between risk and potential returns. UMDD might be a suitable holding within a diversified portfolio for such investors, but only with a smaller allocation to manage the potential downside. High risk tolerance. Investors with a high risk tolerance are comfortable with significant volatility and are willing to accept the potential for larger losses in exchange for the possibility of magnified gains. UMDD could be a larger component of their portfolio strategy, but they should still understand the inherent risks. Risk tolerance considerations. Investment horizon. Investors with a shorter investment horizon might not be able to withstand the potential volatility of UMDD, especially if they need to access their funds within a short time frame. Financial goals. UMDD's focus on magnified daily returns might not be suitable for investors saving for specific goals like retirement, where capital preservation is crucial. Overall portfolio risk. If you already have a portfolio with a moderate or high risk profile due to other holdings, adding UMDD might increase your overall risk exposure beyond your tolerance. Alternative investment options. Non-leveraged mid-cap ETFs. Investors seeking exposure to the mid-cap space with lower volatility can consider non-leveraged ETFs that track the SP Midcap 400 index or a similar benchmark. Broader market ETFs. For a more diversified and potentially less volatile approach, consider ETFs that track broader market indexes like the SP 500. Mutual funds. Actively managed mid-cap mutual funds might offer some potential for capital appreciation with lower volatility compared to UMDD. However, these funds come with their own set of risks and fees. Alright, so we've covered a lot about UMDD. It's an ETF that tracks the mid-cap space with a twist, 3x leverage. This means it amplifies daily returns, both positive and negative. We saw how UMDD can deliver impressive gains like the recent 11.66% surge, but also how it can magnify losses during downturns. UMDD isn't suitable for everyone. Investors with a low risk tolerance should steer clear due to the high volatility. However, for those comfortable with a bit more risk, UMDD could be a strategic portfolio addition, especially within a longer-term investment horizon. Remember, UMDD is just one piece of the puzzle. Consider your overall risk tolerance, investment goals, and existing portfolio diversification before making a decision. If you're interested in learning more about UMDD or other leveraged ETFs, definitely do your own research and consult with a financial advisor. They can help you determine if UMDD aligns with your financial situation. Thanks for joining us today. In the comments below, let us know what you think about leveraged ETFs. Are they a game changer or too risky? We'd love to hear your thoughts.